In this section, we will discuss how the RBI may reduce the policy rate by 25 basis points in the fourth quarter of 2024, according to Oxford Economics. The policy rate is the interest rate at which the RBI lends money to commercial banks. It influences the cost and availability of credit in the economy. Oxford Economics is a global forecasting firm that provides analysis and advice on economic issues. It has recently updated its baseline view for India to include a first rate cut by the RBI in Q4. It thinks that a mix of factors will allow the RBI to shift focus and adopt a more accommodative policy stance sooner. One of the factors is inflation. Inflation is the general increase in the prices of goods and services over time. It erodes the purchasing power of money and affects the economic well-being of people. The RBI has been tasked to ensure retail inflation remains at 4%, with margin of 2% on either side. This means that the RBI tries to keep inflation within a range of 2 to 6%. Oxford Economics says that inflation has already begun easing, and consumer inflation expectations are falling. This means that people expect prices to rise less in the future. It also says that risks to inflation over the remainder of the year are to the upside. This means that there are more chances of inflation going higher than lower due to factors such as rising oil prices, supply disruptions, and fiscal stimulus. However, Oxford Economics believes that the RBI will see clear signs that inflation is stabilizing in the middle of its target range before considering a dovish move. A dovish move is when the central bank lowers interest rates to stimulate economic growth. In its view, this will happen before the end of the year. Another factor is economic activity. Economic activity is the production and consumption of goods and services in an economy. It reflects the level of income, employment, and output in a country. Oxford Economics says that high-frequency indicators for India still suggest robust activity, but activity has clearly begun to slow. It also says that after a resilient first quarter, the global economic slowdown is set to identify, and there are significant risks of a long and deep downturn that will transmit from advanced to emerging economies, including India. This means that the world economy is facing challenges such as trade tensions, geopolitical uncertainties, and environmental issues that could affect India's growth prospects. Therefore, Oxford Economics expects that the RBI will cut its policy rate by 25 basis points in Q4 2024 to support economic recovery and boost demand. A 25 basis point cut means that the policy rate will be reduced by 0.25 percentage points. For example, if the current policy rate is 6.5%, it will be lowered to 6.25%. A lower policy rate will make borrowing cheaper for businesses and consumers, which will encourage them to invest and spend more. This will increase economic activity and create more jobs and income. A lower policy rate will also make Indian assets more attractive for foreign investors, which will increase capital inflows and strengthen the rupee. However, a lower policy rate also has some drawbacks. It could fuel inflation by increasing money supply and demand pressures in the economy. It could also widen the fiscal deficit by reducing government revenue from interest payments on its debt. It could also create financial instability by encouraging excessive risk-taking and leverage in the financial system. Therefore, Oxford Economics says that the RBI will have to balance these trade-offs carefully while deciding on its monetary policy stance. It also says that the RBI will have to monitor other factors such as fiscal policy, exchange rate movements, and global developments that could affect its inflation and growth objectives. This concludes our section on how the RBI may reduce the policy rate by 25 basis points in Q4 2024, according to Oxford Economics.